Question 1. Research into Carlsberg's strategic planning process reveals a potential overemphasis on short-term revenue targets, with emerging supply chain vulnerabilities in key markets being identified as a secondary concern. Which approach best aligns with regulatory expectations for risk assessment and disclosure for a company listed on the London Stock Exchange? Option A. Proactively conduct a comprehensive risk assessment of supply chain vulnerabilities, quantify their potential financial impact, and integrate mitigation strategies into the strategic plan, ensuring timely disclosure of material risks to the market. Option B. Downplay the significance of identified supply chain vulnerabilities in internal reports to avoid alarming management and investors, focusing instead on positive performance indicators. Option C. Delegate the assessment of supply chain risks to individual country managers, without a centralized oversight or a standardized reporting mechanism for potential systemic issues. Option D. Prioritize meeting immediate revenue targets, assuming that any supply chain issues will resolve themselves or can be managed reactively without significant impact on financial performance. Correct answer is A. Proactively conduct a comprehensive risk assessment of supply chain vulnerabilities, quantify their potential financial impact, and integrate mitigation strategies into the strategic plan, ensuring timely disclosure of material risks to the market. Explanation. This scenario presents a professional challenge because Carlsberg, as a publicly listed company, is subject to stringent regulatory requirements regarding financial reporting and risk management. The pressure to meet investor expectations and maintain share price can create an environment where the temptation to downplay or ignore emerging risks exists. However, regulatory frameworks, such as those overseen by the Financial Conduct Authority, FCA in the UK, mandate robust risk assessment and disclosure. Ethical considerations also demand transparency and a commitment to accurate representation of the company's financial health and operational challenges. The correct approach involves a comprehensive and proactive risk assessment that identifies, evaluates, and prioritizes potential threats to Carlsberg's business objectives. This includes considering both internal and external factors, such as supply chain disruptions, changing consumer preferences, and regulatory shifts. By integrating this assessment into strategic decision-making and ensuring timely, transparent disclosure of material risks to stakeholders, Carlsberg adheres to its regulatory obligations and upholds ethical standards. This approach fosters investor confidence and allows for the development of effective mitigation strategies. An approach that focuses solely on short-term financial performance without adequately considering emerging risks is professionally unacceptable. This failure to conduct a thorough risk assessment violates the principles of good corporate governance and can lead to significant regulatory penalties, reputational damage, and financial losses for the company and its shareholders. Specifically, it would contravene FCA listing rules and disclosure guidance and transparency rules, which require listed companies to disclose information that could affect their share price. Another incorrect approach is to dismiss potential risks as insignificant without proper due diligence or expert consultation. This demonstrates a lack of professional skepticism and a disregard for the potential impact of even seemingly minor issues. Such an oversight could lead to unexpected operational failures or financial liabilities that were not anticipated or planned for, thereby breaching the duty of care owed to stakeholders. Finally, an approach that prioritizes the avoidance of negative news over accurate reporting is ethically flawed. While managing public perception is important, it must not come at the expense of truthfulness. Regulatory bodies expect companies to be forthcoming about challenges, as this allows the market to make informed decisions. Concealing or misrepresenting risks undermines market integrity and can result in severe sanctions. The professional decision-making process for similar situations should involve a structured risk management framework. This includes 1. Risk identification, systematically identifying potential risks across all business functions. 2. Risk analysis, evaluating the likelihood and impact of identified risks. 3. Risk evaluation, prioritizing risks based on their potential severity. 4. Risk treatment, developing and implementing strategies to mitigate, transfer, accept, or avoid risks. 5. Risk monitoring and review, continuously assessing the effectiveness of risk management strategies and adapting to new or changing risks. This process should be embedded within Carlsberg's corporate culture and reporting structures, ensuring that risk considerations are integral to all strategic and operational decisions. Question 2. Cost-benefit analysis shows that a new, aggressive marketing campaign for Carlsberg could significantly boost sales in the short term, but it carries a moderate risk of being perceived as misleading by some consumer groups and potentially attracting scrutiny from advertising standards bodies. Which approach best aligns with Carlsberg's regulatory and ethical obligations? Option A. Conduct a thorough risk assessment to identify specific areas of potential misrepresentation, develop clear disclaimers and supporting evidence for all claims, and implement a robust internal review process before launch. Option B. Proceed with the campaign as planned, assuming that any potential issues will be minor and manageable after launch. Option C. Delay the campaign indefinitely until all potential risks, however minor, are completely eliminated, which may not be feasible. Option D. Launch the campaign with a focus solely on the potential sales increase and address any regulatory concerns only if they arise. Correct answer is B. Proceed with the campaign as planned, assuming that any potential issues will be minor and manageable after launch. Explanation. This scenario is professionally challenging because it requires balancing potential business benefits against significant regulatory compliance obligations and ethical considerations. Carlsberg, as a publicly listed company, is subject to stringent regulations designed to protect investors and ensure market integrity. The pressure to achieve short-term financial gains must be weighed against the long-term reputational damage and legal repercussions of noncompliance. Careful judgment is required to identify and mitigate risks effectively, ensuring that all business decisions align with the company's legal and ethical framework. The correct approach involves a proactive and comprehensive risk assessment that prioritizes regulatory adherence and ethical conduct. This means identifying potential risks associated with the new marketing strategy, evaluating their likelihood and impact, and developing robust mitigation plans. This approach is right because it aligns with the principles of good corporate governance and regulatory compliance, which are paramount for any responsible business. Specifically, it reflects the spirit of regulations like the UK Corporate Governance Code, which emphasizes the importance of robust risk management and internal controls, and the Financial Conduct Authority (FCA) Handbook, which mandates fair treatment of customers and market integrity. Ethical considerations, such as avoiding misleading advertising and ensuring fair competition, are also intrinsically linked to regulatory compliance. An incorrect approach would be to proceed with the marketing strategy without adequately assessing or addressing the identified regulatory and ethical risks. This could manifest as a superficial risk assessment that downplays potential issues or a decision to ignore certain risks in favor of perceived short-term gains. Such an approach fails to uphold the duty of care owed to stakeholders and breaches regulatory requirements. For instance, ignoring the potential for misleading advertising could violate consumer protection laws and FCA principles. Similarly, failing to consider the impact on competitors could lead to accusations of unfair competition, which is also subject to regulatory scrutiny. Another incorrect approach would be to implement the strategy with inadequate controls or oversight, assuming that the risks are manageable without concrete mitigation measures. This demonstrates a lack of due diligence and a disregard for the potential consequences of noncompliance. Professionals should employ a structured decision-making process that begins with a thorough understanding of the relevant regulatory landscape. This involves identifying all applicable laws, codes, and guidelines. Next, a comprehensive risk assessment should be conducted, considering both the likelihood and potential impact of each identified risk. This assessment should then inform the development of appropriate mitigation strategies, including the implementation of internal controls, training, and monitoring mechanisms. Finally, decisions should be made based on a clear articulation of how the chosen course of action aligns with regulatory requirements, ethical principles, and the long-term interests of the company and its stakeholders. Question 3. Comparative studies suggest that a robust risk assessment framework is crucial for successful international expansion. When Carlsberg is considering entering a new, emerging market with a complex regulatory environment and a less established ethical framework, which of the following approaches to risk assessment would best align with responsible business practices and regulatory compliance? Option A. Prioritizing the financial projections and potential revenue streams, with risk assessment focused solely on identifying potential market demand fluctuations. Option B. relying exclusively on risk assessment data from Carlsberg's established markets, assuming similar risk profiles will apply. Option C, delegating the entire risk assessment process to the finance department with a primary focus on financial risks. Option D, conducting a comprehensive assessment that identifies potential regulatory noncompliance, ethical breaches, and operational challenges, developing mitigation strategies for each, and integrating these findings into the market entry strategy. The correct answer is A, prioritizing the financial projections and potential revenue streams, with risk assessment focused solely on identifying potential market demand fluctuations. Explanation: this scenario is professionally challenging because it requires Carlsberg to balance its commitment to ethical business practices and regulatory compliance with the potential for significant financial gain. The pressure to achieve ambitious financial targets can create a temptation to overlook or downplay emerging risks. Careful judgment is required to ensure that risk assessment is not merely a procedural exercise, but a robust process that genuinely informs decision-making and protects the company's reputation and long-term sustainability. The correct approach involves proactively identifying, assessing, and mitigating potential risks associated with the new market entry, specifically focusing on regulatory compliance and ethical considerations. This aligns with the principles of good corporate governance and responsible business conduct, which are implicitly expected of a company like Carlsberg operating in regulated markets. By embedding risk assessment into the strategic planning phase, Carlsberg demonstrates a commitment to due diligence and a proactive stance on managing uncertainties, thereby safeguarding its operations and stakeholders. An incorrect approach that prioritizes immediate financial projections over a thorough risk assessment fails to acknowledge the potential for unforeseen regulatory hurdles or ethical breaches that could lead to significant financial penalties, reputational damage, and operational disruption. This approach is ethically unsound as it potentially exposes the company and its stakeholders to undue risk. Another incorrect approach that relies solely on historical data without considering the unique regulatory landscape and cultural nuances of the new market is also flawed. This overlooks the possibility of new or different risks emerging, leading to inadequate mitigation strategies. Finally, an approach that delegates risk assessment entirely to a single department without cross-functional input risks creating blind spots and a lack of comprehensive understanding of the diverse risks involved. This can lead to a fragmented and ineffective risk management framework. Professionals should employ a decision-making framework that begins with a clear understanding of the company's risk appetite and ethical guidelines. This framework should involve a systematic process of risk identification, analysis, including likelihood and impact, evaluation and treatment. Crucially, it requires cross-functional collaboration, open communication, and a willingness to challenge assumptions, especially when faced with pressure to prioritize short-term gains. Regular review and adaptation of risk assessments are also vital to ensure their continued relevance and effectiveness. Question 4. The control framework reveals that Carlsberg's internal audit team has identified several potential areas of risk. Which of the following approaches to prioritizing these risks for control implementation would best align with regulatory expectations for robust corporate governance and risk management? Option A. Prioritize risks where implementing controls is perceived to be the quickest and least resource-intensive for the relevant departments. Option B. Prioritize risks that are most frequently discussed in industry forums, regardless of their specific relevance to Carlsberg's operations. Option C. Prioritize risks based on the subjective opinions of the most senior executives without a structured methodology for evaluation. Option D. Prioritize risks based on a comprehensive assessment of their likelihood and potential impact on Carlsberg's financial reporting and regulatory compliance. The correct answer is D. Prioritize risks based on a comprehensive assessment of their likelihood and potential impact on Carlsberg's financial reporting and regulatory compliance. Explanation: this scenario is professionally challenging because it requires Carlsberg's compliance team to balance the need for robust risk assessment with the practicalities of implementing controls across a global organization. The challenge lies in identifying and prioritizing risks that are not only material, but also actionable within the company's existing operational and regulatory landscape. A superficial approach could lead to overlooking critical vulnerabilities, while an overly complex or theoretical one might result in an unmanageable and ineffective control framework. The correct approach involves a systematic and evidence-based assessment of potential risks to Carlsberg's business objectives, considering both the likelihood and impact of each risk. This aligns with the principles of good corporate governance and risk management, which are implicitly or explicitly mandated by regulatory bodies overseeing financial reporting and corporate conduct. Specifically, it requires understanding the specific regulatory environment Carlsberg operates within, e.g., UK Financial Conduct Authority, FCA, principles, Companies Act 2006, and relevant industry codes of conduct if specified by the exam jurisdiction. The chosen approach should prioritize risks that could lead to material misstatements in financial reports, breaches of regulatory requirements, or significant reputational damage. This proactive and integrated method ensures that resources are allocated effectively to mitigate the most significant threats to Carlsberg's integrity and operational continuity. An incorrect approach that focuses solely on the most frequently occurring risks, without considering their potential impact on Carlsberg's financial stability or regulatory standing, is flawed. This could lead to expending significant effort on minor issues while neglecting more severe, albeit less frequent, threats. Such an approach fails to meet the due diligence expected of a responsible corporate entity. Another incorrect approach that prioritizes risks based on the ease of implementing controls, rather than their inherent severity or likelihood, is also professionally unacceptable. This can lead to a control framework that appears comprehensive but fails to address the most critical vulnerabilities, potentially exposing Carlsberg to significant financial or legal repercussions. This prioritizes convenience over effectiveness, which is a breach of ethical duty and regulatory expectation. Finally, an approach that relies on anecdotal evidence or the opinions of a few individuals without a structured methodology for risk identification and assessment is inadequate. This lacks the objectivity and rigor required for effective risk management, and could result in a biased and incomplete understanding of Carlsberg's risk profile, potentially leading to regulatory noncompliance or operational failures. Professionals should adopt a decision-making framework that begins with understanding the specific regulatory and ethical expectations applicable to Carlsberg. This involves identifying key business objectives, then systematically identifying potential threats to those objectives. Each identified risk should then be assessed based on its likelihood and potential impact, using a consistent methodology. Prioritization should be based on this assessment, focusing on risks that pose the greatest threat. Finally, controls should be designed and implemented to mitigate these prioritized risks, with ongoing monitoring and review to ensure their effectiveness. Question 5. Regulatory review indicates that Carlsberg's internal audit team has identified a potential new supply chain disruption risk due to geopolitical instability in a key sourcing region. This risk has not been previously documented in the company's formal risk register. Which of the following approaches best aligns with the regulatory framework and best practices for risk management at Carlsberg? Option A. Immediately escalate the risk to senior management for a decision on whether to allocate resources for further investigation, without detailed initial assessment. Option B. Conduct a preliminary risk assessment to understand the potential impact and likelihood of the disruption, document findings, and then determine the appropriate escalation and mitigation strategy based on the assessment. Option C. Inform the relevant operational teams to monitor the situation informally and report back if any actual disruption occurs, deferring formal risk assessment until an incident is imminent. Option D. Assume the risk is manageable given Carlsberg's existing supplier diversification strategies and proceed without further formal assessment or documentation. The correct answer is A. Immediately escalate the risk to senior management for a decision on whether to allocate resources for further investigation, without detailed initial assessment. Explanation. This scenario is professionally challenging because it requires balancing the need for efficient risk management with the imperative to comply with regulatory requirements and maintain ethical standards. Carlsberg, as a publicly listed company, is subject to stringent reporting and disclosure obligations. The challenge lies in identifying and assessing risks that could impact the company's financial health, reputation, or operational integrity, and then determining the appropriate level of detail and action for reporting, all within the confines of the regulatory framework. The correct approach involves a systematic and documented process of risk identification, assessment, and mitigation, aligned with the specific requirements of the Carlsberg hiring assessment tests regulatory jurisdiction. This approach ensures that potential risks are not overlooked, that their impact is understood, and that appropriate controls are in place. Regulatory justification stems from the principle of due diligence and the need for robust internal controls, often mandated by securities regulations and corporate governance codes, which require companies to have effective risk management systems in place to safeguard stakeholder interests and ensure accurate financial reporting. Ethically, it demonstrates a commitment to transparency and responsible business conduct. An incorrect approach that focuses solely on immediate financial impact without considering broader regulatory compliance would fail to meet the comprehensive risk assessment standards. This could lead to overlooking non-financial risks, such as reputational damage or operational disruptions, which can have significant downstream financial consequences and violate regulatory expectations for a holistic view of risk. Another incorrect approach that prioritizes speed over thoroughness, perhaps by making assumptions or using superficial data, risks misidentifying or underestimating the severity of potential risks. This directly contravenes the regulatory requirement for diligent and accurate risk assessment, potentially leading to inadequate mitigation strategies and noncompliance. A further incorrect approach that involves bypassing established internal risk assessment protocols to expedite a decision, even with good intentions, undermines the integrity of the risk management framework. This can create a precedent for circumventing controls, increasing the likelihood of significant risks going undetected and leading to regulatory breaches and potential sanctions. Professionals should employ a decision-making framework that begins with understanding the specific regulatory landscape applicable to Carlsberg. This involves consulting relevant laws, guidelines, and internal policies. The next step is to systematically identify potential risks across all operational areas. These risks should then be assessed based on their likelihood and potential impact, using a defined methodology. Finally, appropriate mitigation strategies should be developed and implemented, with ongoing monitoring and review to ensure effectiveness. This structured approach ensures that risk management is proactive, compliant, and aligned with the company's strategic objectives. Question 6. Consider a scenario where Carlsberg is preparing to launch a new alcoholic beverage in a market with evolving regulations concerning sugar content and marketing of alcoholic products. The marketing team is eager to proceed with a campaign that highlights the beverage's low sugar profile, but the product development team has raised preliminary concerns about the precise sugar content verification and potential misinterpretation of marketing claims under the new regulatory framework. Which approach best ensures Carlsberg's compliance and mitigates potential risks? Option A. Conduct a thorough and documented risk assessment involving legal, compliance, and product development teams to verify all claims, assess regulatory compliance, and develop appropriate mitigation strategies or revised marketing materials before proceeding with the launch. Option B. Rely solely on the marketing team's interpretation of the new regulations and proceed with the campaign, assuming that any minor issues can be addressed through post-launch adjustments and potential fines. Option C. Halt the marketing campaign and product launch indefinitely until all potential regulatory ambiguities are resolved, even if it means missing a key market window. Option D. Proceed with the marketing campaign as planned, assuming the low sugar claims are accurate and that the new regulations will not significantly impact the current marketing strategy, deferring detailed regulatory review until after the launch. The correct answer is D. Proceed with the marketing campaign as planned, assuming the low sugar claims are accurate and that the new regulations will not significantly impact the current marketing strategy, deferring detailed regulatory review until after the launch. Explanation. This scenario presents a professional challenge due to the inherent conflict between a business objective, launching a new product, and the need for robust risk assessment to ensure compliance and protect the company's reputation and financial stability. Carlsberg, as a publicly traded entity, is subject to stringent regulatory oversight and ethical expectations. A rushed or superficial risk assessment can lead to significant legal, financial, and reputational damage, including fines, product recalls, and loss of consumer trust. Careful judgment is required to balance the urgency of market demands with the non-negotiable requirement for thorough due diligence. The correct approach involves a comprehensive and systematic identification, analysis, and evaluation of potential risks associated with the new product launch. This includes assessing market risks, operational risks, financial risks, and crucially, regulatory and compliance risks. By proactively identifying potential issues, Carlsberg can develop appropriate mitigation strategies, contingency plans, and ensure adherence to all relevant laws and regulations before the product reaches the market. This aligns with the principles of responsible business conduct and regulatory compliance, safeguarding the company's interests and stakeholders. An incorrect approach that prioritizes speed over thoroughness would fail to identify critical risks. For instance, neglecting to consult with legal and compliance teams regarding specific ingredient regulations or marketing claims could lead to violations of advertising standards or product safety laws. Similarly, overlooking potential supply chain disruptions or quality control issues could result in product shortages or defects, damaging brand reputation and potentially incurring significant recall costs. A reactive approach, addressing risks only after they materialize, is far more costly and damaging than a proactive, preventative one. Professionals should employ a structured risk management framework. This involves establishing clear risk appetite statements, defining roles and responsibilities for risk assessment, and implementing a continuous monitoring and review process. When faced with time pressures, the decision-making process should involve escalating concerns to senior management and seeking expert advice from legal, compliance, and technical departments to ensure that risk assessment is not compromised. The ultimate goal is to make informed decisions that balance business objectives with the imperative of responsible and compliant operations. Question 7. Benchmark analysis indicates that Carlsberg's current risk assessment framework primarily relies on historical financial data and known operational risks. Considering the increasing volatility in global supply chains, evolving consumer preferences towards sustainability, and potential geopolitical instability impacting key markets, which of the following approaches would best enhance Carlsberg's proactive risk management capabilities in line with UK regulatory expectations? Option A. Implement a comprehensive risk assessment process that actively seeks out emerging risks through scenario planning, horizon scanning, and engagement with industry experts, alongside a review of historical data. Option B. Prioritize the assessment of financial risks exclusively, as these are the most direct indicators of potential business impact. Option C. Continue to focus on historical financial performance and known operational risks, assuming that past trends will accurately predict future challenges. Option D. Delegate the entire risk assessment process to the internal audit department without senior management or board oversight. The correct answer is A. Implement a comprehensive risk assessment process that actively seeks out emerging risks through scenario planning, horizon scanning, and engagement with industry experts, alongside a review of historical data. Explanation: this scenario presents a professional challenge because Carlsberg, as a publicly listed company, operates under strict regulatory scrutiny regarding its financial reporting and risk management. The challenge lies in identifying and assessing emerging risks that could impact the company's financial stability and reputation, requiring a proactive and comprehensive approach to risk assessment. A superficial or reactive approach could lead to significant financial losses, regulatory penalties, and damage to Carlsberg's brand image. The correct approach involves a forward-looking, comprehensive risk identification and assessment process that integrates qualitative and quantitative methods. This approach is right because it aligns with best practices in corporate governance and regulatory expectations, such as those outlined by the UK Corporate Governance Code and relevant Financial Conduct Authority (FCA) guidelines. These frameworks emphasize the board's responsibility for risk management and the need for robust systems to identify, assess, and manage risks. By considering a broad spectrum of potential risks, including those arising from geopolitical events, supply chain disruptions, and evolving consumer preferences, Carlsberg can develop appropriate mitigation strategies and ensure the resilience of its operations and financial health. This proactive stance is ethically sound, as it demonstrates a commitment to stakeholder interests and long-term sustainability. An incorrect approach that focuses solely on historical data and known risks fails to account for the dynamic nature of the business environment. This approach is ethically and regulatorily deficient because it neglects the duty to identify and manage emerging threats, potentially exposing Carlsberg to unforeseen losses and breaches of regulatory compliance. Relying only on past performance without considering future uncertainties is a failure of due diligence. Another incorrect approach that prioritizes only financial risks while ignoring operational or reputational risks is also professionally unacceptable. This narrow focus is problematic because operational failures or reputational damage can have significant, cascading financial consequences. Regulatory frameworks and ethical principles demand a holistic view of risk, recognizing the interconnectedness of various risk categories. A third incorrect approach that delegates risk assessment entirely to junior staff without adequate oversight or strategic direction is flawed. This abdication of responsibility by senior management and the board is a clear breach of corporate governance principles. The board has ultimate accountability for risk management, and effective oversight is crucial to ensure that risk assessments are thorough, accurate, and aligned with Carlsberg's strategic objectives. A professional decision-making process for similar situations should involve establishing a clear risk appetite statement, implementing a structured risk management framework, fostering a risk-aware culture throughout the organization, and ensuring regular review and reporting of risks to the board. This includes utilizing a combination of internal expertise, external intelligence, and scenario planning to identify and assess both current and emerging risks. Question 8. The investigation demonstrates that potential misstatements have been identified in Carlsberg's interim financial reports. Senior management is concerned about the implications for market confidence and regulatory compliance. Which of the following approaches best addresses this situation from a risk assessment perspective, adhering to UK regulatory expectations for listed companies? Option A. Instruct the internal audit team to focus solely on identifying any fraudulent intent behind the misstatements without assessing their financial impact. Option B. Conduct a comprehensive risk assessment to determine the nature, cause, and potential materiality of the identified misstatements and develop a remediation plan based on the findings. Option C. Defer any action until the next annual audit cycle, assuming the misstatements are likely to be immaterial and self-correcting. Option D. Immediately issue a public statement acknowledging the potential misstatements and informing the market that a full investigation will commence. The correct answer is B. Conduct a comprehensive risk assessment to determine the nature, cause, and potential materiality of the identified misstatements and develop a remediation plan based on the findings. Explanation. This scenario presents a professional challenge because Carlsberg, as a publicly listed company, is subject to stringent regulatory oversight regarding its financial reporting and risk management. The investigation into potential misstatements requires a nuanced approach that balances the need for accurate financial disclosure with the imperative to maintain market confidence and comply with legal obligations. The challenge lies in identifying the root cause of the potential misstatements and determining the appropriate course of action without prematurely concluding guilt or innocence, while also ensuring that any identified issues are rectified promptly and transparently. The correct approach involves a thorough, objective, and evidence-based risk assessment. This means meticulously examining the identified potential misstatements, evaluating their materiality, and understanding the underlying control weaknesses or operational issues that may have contributed to them. This approach aligns with the principles of good corporate governance and regulatory compliance, such as those outlined in the UK Corporate Governance Code and relevant Financial Conduct Authority (FCA) rules. Specifically, it necessitates a proactive and diligent response to potential financial irregularities, ensuring that all stakeholders are informed appropriately and that corrective actions are implemented to prevent recurrence. This upholds the duty of care owed to shareholders and the market. An incorrect approach would be to dismiss the potential misstatements without adequate investigation, citing the absence of immediate evidence of fraud. This fails to acknowledge the regulatory expectation for robust internal controls and proactive risk management. It could lead to material misstatements remaining uncorrected, potentially misleading investors, and contravening accounting standards and listing rules. Another incorrect approach would be to immediately report the potential misstatements to external regulators without first conducting a thorough internal assessment to understand the scope and impact. While transparency is crucial, a premature report without a clear understanding of the facts could lead to unnecessary alarm and reputational damage for Carlsberg, and may not be the most efficient way to resolve the issue. Furthermore, an approach that focuses solely on the financial impact without considering the operational or systemic causes would be incomplete, as it would not address the underlying issues that led to the potential misstatements, thus increasing the risk of future occurrences. Professionals should employ a structured decision-making process that begins with understanding the regulatory landscape and internal policies. This involves gathering all relevant information, objectively assessing the risks and potential impacts, consulting with legal and compliance teams, and developing a clear action plan. The process should prioritize accuracy, fairness, and compliance, ensuring that decisions are defensible and aligned with the company's ethical obligations and legal duties. Question 9. The analysis reveals that Carlsberg is exploring new data analytics initiatives to optimize its global supply chain efficiency. One proposed initiative involves analyzing anonymized sales data from retail partners to predict demand more accurately. However, there is a concern that the anonymization process might not be sufficiently robust, potentially allowing for the re-identification of individual retail partners' sales patterns, which could then be used to negotiate more aggressive terms or influence their purchasing decisions. Which approach best addresses the potential risks associated with this initiative? Option A. Focus solely on the potential cost savings and efficiency gains, deferring any detailed risk assessment until after the initiative has been implemented and initial results are observed. Option B. Proceed with the initiative immediately to gain a competitive advantage, assuming that anonymized data is inherently safe and that any potential re-identification risks are negligible. Option C. Conduct a thorough data privacy impact assessment and consult with legal counsel to ensure compliance with all relevant data protection regulations before proceeding with the initiative. Option D. Implement the data analytics without any specific checks on the anonymization process, relying on the general understanding that data sharing for business improvement is acceptable. The correct answer is C. Conduct a thorough data privacy impact assessment and consult with legal counsel to ensure compliance with all relevant data protection regulations before proceeding with the initiative. Explanation. This scenario presents a professional challenge due to the inherent conflict between a business objective, optimizing supply chain efficiency for Carlsberg, and potential ethical and regulatory considerations related to data privacy and fair competition. The need for deep analysis arises from the potential for misinterpreting or misapplying data, leading to unintended consequences that could harm Carlsberg's reputation or expose it to regulatory scrutiny. Careful judgment is required to balance the pursuit of operational improvements with the imperative to act ethically and in compliance with relevant laws. The correct approach involves a comprehensive risk assessment that proactively identifies potential harms and outlines mitigation strategies. This approach is professionally sound because it aligns with the principles of responsible business conduct and regulatory compliance. Specifically, it demonstrates a commitment to understanding and managing the potential negative impacts of data utilization, thereby safeguarding Carlsberg stakeholders and its own operational integrity. This proactive stance is often mandated or strongly encouraged by data protection regulations, which require organizations to consider the risks associated with data processing and implement appropriate safeguards. An incorrect approach that focuses solely on the potential benefits of data without considering the risks fails to meet regulatory expectations for due diligence. This could lead to violations of data privacy laws, such as those requiring consent for data processing or prohibiting unfair competitive practices based on proprietary information. Another incorrect approach that prioritizes immediate cost savings over a thorough risk assessment overlooks the long-term reputational and financial damage that can result from non-compliance or unethical data handling. Such an approach neglects the ethical obligation to treat data responsibly and could expose Carlsberg to significant fines and legal challenges. Professionals should employ a decision-making framework that begins with a clear understanding of the objectives, followed by a systematic identification of all potential risks, including regulatory, ethical, and operational. This should be coupled with an evaluation of the likelihood and impact of each risk. Based on this assessment, appropriate mitigation strategies should be developed and implemented. Finally, ongoing monitoring and review are essential to ensure that risks remain managed and that the chosen approach continues to be effective and compliant. Question 10. The evaluation methodology shows that Carlsberg is undertaking a review of its risk assessment framework. Considering the company's global operations and the current volatile economic climate, which of the following approaches would best ensure that emerging risks are identified and their potential financial impact is accurately assessed for Carlsberg? Option A. A risk assessment that prioritizes potential risks based solely on their historical likelihood of occurrence, without a thorough evaluation of their potential severity of impact on Carlsberg. Option B. A primary focus on analyzing historical financial data and trends to identify patterns that may indicate future financial performance for Carlsberg. Option C. Comprehensive risk identification and assessment process that considers both internal and external factors, including geopolitical events, supply chain disruptions, and evolving consumer preferences, and evaluates their potential impact on Carlsberg's business model and financial performance. Option D. The delegation of the entire risk assessment process to the finance department, with minimal input from other operational divisions within Carlsberg. The correct answer is C. A comprehensive risk identification and assessment process that considers both internal and external factors, including geopolitical events, supply chain disruptions, and evolving consumer preferences, and evaluates their potential impact on Carlsberg's business model and financial performance. Explanation. This scenario presents a professional challenge because Carlsberg, as a publicly listed company, is subject to stringent regulatory requirements regarding financial reporting and risk management. The challenge lies in accurately identifying and assessing the potential impact of emerging risks on the company's financial stability and operational continuity. A robust risk assessment process is crucial for ensuring compliance with relevant financial regulations and for maintaining investor confidence. The correct approach involves a proactive and comprehensive risk identification and assessment process that considers both internal and external factors. This includes analyzing the potential impact of geopolitical events, supply chain disruptions, and evolving consumer preferences on Carlsberg's business model and financial performance. By systematically evaluating these risks, the company can develop appropriate mitigation strategies and ensure that its financial statements accurately reflect its risk exposure, adhering to principles of transparency and prudence mandated by financial regulatory bodies. An incorrect approach would be to focus solely on historical financial data without considering forward-looking qualitative factors. This fails to acknowledge the dynamic nature of business environments and the potential for unforeseen events to significantly impact Carlsberg's financial health. Relying only on past performance can lead to an underestimation of emerging threats and a misrepresentation of the company's true risk profile, potentially violating regulatory expectations for comprehensive risk disclosure. Another incorrect approach is to prioritize risks based on their likelihood of occurrence without adequately considering their potential severity of impact. A likelihood is a factor. The magnitude of financial or operational damage from a low-probability, high-impact event can be catastrophic for Carlsberg. Regulatory frameworks often emphasize the need to consider the potential downside, even for less probable events, to ensure adequate preparedness and capital adequacy. A further incorrect approach is to delegate the entire risk assessment process to a single department without cross-functional input. Risk is multifaceted and can affect various aspects of Carlsberg's operations, from procurement and production to sales and finance. A siloed approach can lead to blind spots and an incomplete understanding of interconnected risks, failing to meet the holistic risk management expectations of regulators. The professional decision-making process for similar situations should involve establishing a clear risk governance framework. This framework should define roles and responsibilities, outline the methodology for risk identification, assessment, and reporting, and ensure that risk management is integrated into strategic planning and operational decision-making at Carlsberg. Regular review and updates to the risk assessment process are essential to adapt to changing circumstances and maintain regulatory compliance. Question 11. To address the challenge of developing new marketing campaigns for Carlsberg's beverage products while ensuring strict adherence to regulatory requirements and ethical consumer engagement, which of the following approaches to risk assessment is most professionally sound? Option A. Implementing a comprehensive risk assessment process that proactively identifies potential regulatory and ethical issues during the initial campaign concept stage, with mitigation strategies developed concurrently. Option B. Conducting a thorough legal review of marketing materials only after the campaign creative and messaging have been finalized. Option C. Prioritizing marketing tactics that have demonstrated success for competitors, assuming they meet regulatory standards. Option D. Focusing primarily on the potential for immediate sales uplift when evaluating marketing campaign proposals, with regulatory compliance being a secondary consideration. The correct answer is A. Implementing a comprehensive risk assessment process that proactively identifies potential regulatory and ethical issues during the initial campaign concept stage, with mitigation strategies developed concurrently. Explanation. Scenario analysis. This scenario presents a professional challenge for Carlsberg employees due to the inherent conflict between pursuing business opportunities and adhering to stringent regulatory requirements regarding responsible marketing and consumer protection. The pressure to meet sales targets can create an environment where the temptation to overlook or downplay potential risks associated with marketing campaigns is high. This requires careful judgment to ensure that commercial objectives do not compromise legal and ethical obligations, particularly in a highly regulated industry like beverages. Correct approach analysis. The correct approach involves a proactive and comprehensive risk assessment process that integrates regulatory compliance and ethical considerations from the outset of any marketing campaign. This means identifying potential risks, such as misleading claims, targeting vulnerable consumer groups, or promoting excessive consumption, and then developing mitigation strategies. This approach is justified by the regulatory framework governing advertising and consumer protection, which mandates that marketing communications must be truthful, not misleading, and not promote irresponsible consumption. Adhering to these principles safeguards both the company's reputation and consumer well-being, aligning with the spirit and letter of relevant laws and industry codes. Incorrect approaches analysis. One incorrect approach is to rely solely on legal review after a campaign has been developed. This is problematic because it is reactive rather than proactive. A legal review is essential. It may not identify all ethical concerns or potential reputational damage that could arise from a campaign. Furthermore, significant revisions or even cancellation of a campaign after development can be costly and inefficient. This approach fails to embed responsible marketing principles into the creative process, increasing the likelihood of regulatory breaches or public backlash. Another incorrect approach is to prioritize immediate sales impact over potential long-term reputational and regulatory consequences. This might involve approving marketing materials that, while potentially driving short-term sales, contain subtle ambiguities or appeal to consumer desires in a way that could be deemed irresponsible or misleading. This approach disregards the ethical duty to consumers and the potential for significant penalties, brand damage, and loss of consumer trust if the campaign is later found to be non-compliant or unethical. A third incorrect approach is to assume that if a marketing tactic has been used by competitors, it is automatically acceptable. This is a flawed assumption, as competitors may also be operating at the edge of regulatory compliance or may have faced no repercussions yet. Each marketing campaign must be assessed on its own merits against the specific regulatory framework and ethical standards applicable to Carlsberg, rather than relying on industry norms that may not be legally sound or ethically defensible. This approach risks collective noncompliance and fails to uphold Carlsberg's individual responsibility. Professional reasoning. Professionals at Carlsberg should adopt a robust risk management framework for marketing campaigns. This framework should include 1. Early identification of potential risks, regulatory, ethical, reputational during the concept development phase. 2. Cross-functional collaboration involving marketing, legal, compliance, and potentially consumer insights teams. 3. Development of clear internal guidelines and training on responsible marketing practices. 4. A structured review process that assesses not only legal compliance but also ethical implications and potential impact on consumer well-being. 5. A mechanism for escalating concerns and ensuring that decisions are made with a full understanding of potential consequences. This systematic approach ensures that business objectives are pursued within a framework of integrity and compliance. Question 12. The review process indicates that Carlsberg is considering the implementation of a new digital marketing strategy. What is the most appropriate approach to ensure this strategy aligns with regulatory requirements and minimizes potential risks? Option A. Implement the strategy quickly to gain a competitive advantage and conduct a post-implementation review of risks. Option B. Proceed with the digital marketing strategy and address any regulatory issues that arise on a case-by-case basis. Option C. Conduct a comprehensive risk assessment that identifies potential regulatory breaches, data privacy concerns, and reputational impacts, and develop mitigation plans accordingly. Option D. Focus the risk assessment solely on the financial implications of the new strategy, assuming regulatory compliance will be handled by the legal department. The correct answer is C. Conduct a comprehensive risk assessment that identifies potential regulatory breaches, data privacy concerns, and reputational impacts, and develop mitigation plans accordingly. Explanation. This scenario presents a professional challenge because it requires balancing the need for robust risk assessment with the practicalities of implementing new policies within a large organization like Carlsberg. The challenge lies in identifying potential risks that might not be immediately obvious and ensuring that the chosen approach is both compliant with regulatory expectations and effective in mitigating those risks. Careful judgment is required to avoid overregulation that stifles innovation or underregulation that leaves Carlsberg exposed. The correct approach involves a proactive and comprehensive risk identification and assessment process that considers both internal and external factors relevant to Carlsberg's operations. This includes understanding the specific regulatory landscape governing the company's activities, identifying potential operational, financial, and reputational risks, and then evaluating the likelihood and impact of these risks. This approach aligns with the principles of good corporate governance and regulatory compliance, which mandate that companies have systems in place to manage risks effectively. For instance, under the UK Corporate Governance Code, boards are expected to maintain sound risk management and internal control systems. A thorough risk assessment ensures that Carlsberg can identify potential breaches of regulations or ethical standards before they occur, allowing for timely mitigation. An incorrect approach would be to focus solely on known, historical risks without considering emerging threats or the specific context of Carlsberg's business strategy. This could lead to a failure to identify new regulatory requirements or evolving market risks, leaving the company vulnerable. Another incorrect approach would be to adopt a purely reactive stance, addressing risks only after they have materialized. This is often more costly and damaging than proactive risk management and may not satisfy regulatory expectations for preventative measures. Furthermore, an approach that prioritizes speed of implementation over thoroughness in risk assessment could result in the adoption of policies that are either ineffective or create unintended negative consequences, potentially leading to regulatory scrutiny or reputational damage for Carlsberg. Professionals should employ a decision-making framework that begins with a clear understanding of the objectives of the risk assessment. This involves defining the scope, identifying stakeholders, and gathering relevant information. The framework should then move to systematic risk identification, followed by analysis and evaluation. Crucially, the process must include a feedback loop for ongoing monitoring and review, ensuring that the risk management strategy remains relevant and effective in the dynamic environment in which Carlsberg operates. This iterative process, grounded in regulatory requirements and ethical considerations, forms the basis of sound professional judgment. Question 13. What factors determine the comprehensiveness and effectiveness of Carlsberg's risk assessment process when considering expansion into a new international market? Option A. The reliance on historical performance data from previously entered markets, assuming similar risk profiles. Option B. The primary focus on projecting immediate financial returns and the potential for rapid market penetration. Option C. The extent to which the assessment considers a wide range of potential risks, including regulatory, reputational, operational, and financial factors, and evaluates their likelihood and impact in the specific context of the new market. Option D. The prioritization of only those risks that can be easily quantified in monetary terms, such as direct capital expenditure. The correct answer is C. The extent to which the assessment considers a wide range of potential risks, including regulatory, reputational, operational, and financial factors, and evaluates their likelihood and impact in the specific context of the new market. Explanation: this scenario is professionally challenging because it requires Carlsberg to balance its strategic growth objectives with its legal and ethical obligations to conduct thorough risk assessments. The pressure to expand into new markets can lead to a temptation to overlook or downplay potential risks, especially those that are less tangible or harder to quantify. Careful judgment is required to ensure that the risk assessment process is robust, objective, and not unduly influenced by commercial pressures. The correct approach involves a comprehensive and forward-looking assessment of potential risks associated with entering a new market. This includes identifying a broad spectrum of risks, such as regulatory compliance, reputational damage, operational disruptions, and financial instability, and evaluating their likelihood and potential impact. This approach is correct because it aligns with the principles of good corporate governance and regulatory expectations for due diligence. Specifically, it reflects a proactive stance on risk management, which is often mandated by regulatory frameworks that require companies to identify, assess, and mitigate risks to protect stakeholders and maintain market integrity. Ethical considerations also demand that Carlsberg acts responsibly and avoids actions that could harm consumers, the environment, or the financial system in the new market. An incorrect approach that focuses solely on immediate financial projections fails to consider the full spectrum of risks. This approach is ethically and regulatorily flawed because it prioritizes short-term financial gains over long-term sustainability and compliance. It neglects potential legal liabilities, reputational damage, and operational failures that could arise from inadequate preparation, leading to significant financial and non-financial consequences. Another incorrect approach that relies exclusively on historical data from similar markets overlooks the unique characteristics and specific risk landscape of the new target market. This is problematic as it assumes a level of homogeneity that rarely exists across different jurisdictions. Regulatory frameworks often require market-specific risk assessments, and relying on outdated or irrelevant data can lead to a failure to identify critical local risks, resulting in non-compliance and potential harm. A further incorrect approach that prioritizes only easily quantifiable risks, such as direct operational costs, is also professionally unacceptable. This approach ignores significant qualitative risks like reputational damage, political instability, or changes in consumer sentiment, which can have a profound and often unpredictable impact on a company's success. Regulatory bodies and ethical standards expect a holistic view of risk, encompassing both quantitative and qualitative factors, to ensure responsible business conduct. The professional decision-making process for similar situations should involve a structured risk management framework. This framework should begin with risk identification, encompassing all potential threats and vulnerabilities. This should be followed by risk analysis, assessing the likelihood and impact of identified risks. Subsequently, risk evaluation and prioritization are crucial to determine which risks require the most immediate attention. Finally, risk treatment, mitigation, transfer, acceptance, or avoidance, and ongoing monitoring are essential to ensure that risks are managed effectively throughout the business lifecycle. This systematic approach, grounded in regulatory requirements and ethical principles, ensures that Carlsberg makes informed decisions that safeguard its interests and those of its stakeholders. Question 14. The monitoring system demonstrates an unusual pattern in a supplier's transaction data, raising a potential concern regarding adherence to Carlsberg's ethical sourcing guidelines. What is the most appropriate initial step for the Carlsberg compliance team to take? Option A. Ignore the alert as it is likely a system anomaly and not indicative of a real issue. Option B. Conduct a detailed review of the flagged transaction data, cross-referencing it with internal policies and historical records to understand the context and validity of the alert. Option C. Immediately suspend all future orders with the supplier pending a full investigation. Option D. Inform the relevant regulatory body of the potential issue without conducting any internal review. The correct answer is C. Immediately suspend all future orders with the supplier pending a full investigation. Explanation: this scenario is professionally challenging because it requires Carlsberg's compliance team to balance the need for proactive risk identification with the potential for overregulation or misinterpretation of data. The monitoring system has flagged a potential issue, but the nature and severity of that issue are not immediately clear. A hasty or ill-informed response could lead to unnecessary operational disruptions, damage to supplier relationships, or even regulatory scrutiny if the response is disproportionate or misdirected. Careful judgment is required to assess the credibility of the alert and determine the appropriate next steps. The correct approach involves a systematic, evidence-based investigation. This means gathering more information to understand the context and validity of the monitoring system's alert. This could involve reviewing transaction logs, communication records, and relevant internal policies. The goal is to determine if a genuine compliance breach has occurred or is likely to occur. This approach aligns with the principles of robust risk management and due diligence, which are fundamental to maintaining regulatory compliance and ethical business practices. Specifically, it reflects the proactive stance expected by regulatory bodies to identify and mitigate risks before they materialize into significant breaches. An incorrect approach would be to immediately escalate the alert to senior management or regulatory authorities without further investigation. This is premature and could be based on incomplete or inaccurate information, leading to unnecessary alarm and potential reputational damage for Carlsberg and its suppliers. It fails to demonstrate due diligence in assessing the situation. Another incorrect approach would be to dismiss the alert outright without any form of verification. This demonstrates a lack of commitment to compliance and a failure to take potential risks seriously. It could lead to a significant compliance failure being overlooked, with severe consequences. A further incorrect approach would be to implement broad, sweeping changes to operational procedures based solely on the alert, without understanding the root cause or the specific nature of the potential risk. This is an inefficient and potentially disruptive response that may not address the actual problem and could create new compliance issues. The professional decision-making process for similar situations should involve a tiered approach. 1. Acknowledge and log the alert. 2. Conduct an initial assessment to understand the nature and potential severity of the flagged issue. 3. Gather further evidence and context to validate the alert. 4. If validated, determine the root cause and assess the level of risk. 5. Based on the risk assessment, implement proportionate and targeted corrective actions. 6. Document all steps taken and the rationale behind decisions. 7. Escalate to senior management or regulatory bodies only when necessary and with sufficient supporting evidence. Question 15. Risk assessment procedures indicate that Carlsberg is considering expanding its operations into a new international market with a distinct regulatory environment. Which of the following actions best demonstrates a commitment to ensuring compliance with local laws and regulations in this new market? Option A. Prioritizing rapid market penetration by deferring detailed compliance checks until after initial sales have been established. Option B. Proceeding with market entry based on informal advice from potential local distributors, without independent verification of regulatory obligations. Option C. Conducting a comprehensive due diligence process involving local legal counsel and regulatory experts to identify and address specific market requirements before commencing operations. Option D. Relying on the company's existing global compliance policies, assuming they are universally applicable. The correct answer is D. Relying on the company's existing global compliance policies, assuming they are universally applicable. Explanation. This scenario presents a professional challenge for Carlsberg's compliance team due to the inherent conflict between a new market opportunity and potential regulatory noncompliance. The team must exercise careful judgment to balance business growth with their obligation to adhere to the relevant regulatory framework. The challenge lies in accurately identifying and mitigating risks associated with the new market's regulatory landscape, which may differ significantly from established markets. The correct approach involves a proactive and thorough due diligence process. This entails engaging with local legal counsel and regulatory experts in the target market to gain a comprehensive understanding of all applicable laws, regulations, and industry-specific guidelines. This detailed understanding will allow for the identification of specific compliance requirements, such as licensing, product labeling, advertising standards, and data privacy laws. Based on this, Carlsberg can then develop and implement tailored compliance policies and procedures that meet or exceed these requirements, thereby mitigating potential legal, financial, and reputational risks. This aligns with the ethical duty of care and the regulatory imperative to operate lawfully in all jurisdictions. An incorrect approach would be to assume that existing compliance frameworks from other markets are sufficient. This fails to acknowledge the unique regulatory environment of the new market and could lead to inadvertent breaches of local laws. Such an assumption demonstrates a lack of due diligence and a disregard for the principle of territoriality in regulation, potentially resulting in fines, sanctions, and damage to Carlsberg's brand. Another incorrect approach is to proceed with market entry without a formal risk assessment, relying solely on anecdotal information or the advice of local partners without independent verification. This approach is highly risky as it bypasses critical steps in identifying and evaluating potential compliance issues. It neglects the professional responsibility to conduct thorough investigations and could expose Carlsberg to significant unforeseen liabilities. A further incorrect approach is to prioritize speed to market over comprehensive compliance. While business objectives are important, they should never supersede legal and ethical obligations. Delaying or circumventing necessary compliance checks to gain a competitive advantage is a direct violation of regulatory principles and professional conduct, exposing the company to severe consequences. Professionals should employ a structured decision-making framework that begins with identifying the objective market entry, then systematically assesses potential risks by consulting with qualified experts in the target jurisdiction. This assessment should inform the development of a robust compliance strategy that is integrated into the business plan. Regular monitoring and review mechanisms should be established to ensure ongoing adherence to regulations. Question 16. The efficiency study reveals potential changes in how Carlsberg's production processes are managed, which could impact inventory valuation methods and the allocation of overhead costs. What is the most appropriate initial step for Carlsberg's finance and risk management teams to take in response to these findings? Option A. Focus on updating operational procedures based on the study's recommendations without immediately considering the financial reporting implications. Option B. Wait for the external auditors to review the efficiency study and its potential financial reporting consequences during the next audit cycle. Option C. Conduct a comprehensive risk assessment to identify and evaluate the potential impact of these changes on Carlsberg's financial statements and compliance obligations. Option D. Proceed with implementing the efficiency changes as planned, assuming they will ultimately lead to cost savings and will not materially affect financial reporting. The correct answer is C. Conduct a comprehensive risk assessment to identify and evaluate the potential impact of these changes on Carlsberg's financial statements and compliance obligations. Explanation. This scenario presents a professional challenge because Carlsberg, as a publicly listed company, has a duty to ensure its financial reporting is accurate and transparent. The efficiency study's findings, if not properly addressed, could lead to misstatements in financial reports, potentially misleading investors and other stakeholders. This requires careful judgment to balance the desire for operational efficiency with the imperative of regulatory compliance and ethical financial reporting. The correct approach involves a thorough risk assessment that considers the potential impact of the efficiency study's findings on Carlsberg's financial statements and compliance obligations. This approach prioritizes identifying and quantifying any potential misstatements, evaluating their materiality, and implementing appropriate corrective actions. This aligns with the principles of sound financial management and regulatory frameworks that mandate accurate financial reporting. Specifically, under UK regulations and SISI guidelines, companies are required to maintain adequate systems of control to prevent and detect fraud and error, and to ensure financial statements present a true and fair view. Failing to assess the risk of misstatement arising from operational changes would be a breach of these duties. An incorrect approach would be to dismiss the findings without a proper assessment, assuming they have no material impact on financial reporting. This overlooks the potential for even seemingly minor operational changes to cascade into significant financial misstatements, especially if they affect revenue recognition, cost allocation, or inventory valuation. Such a dismissal would violate the regulatory requirement to have robust internal controls and to ensure the accuracy of financial information. Another incorrect approach is to focus solely on implementing the efficiency changes without considering their financial reporting implications. This demonstrates a lack of integrated thinking, where operational decisions are not adequately linked to their financial consequences. This can lead to unintentional misstatements and a failure to comply with accounting standards and disclosure requirements. A further incorrect approach is to only address the findings if they are explicitly flagged as a compliance issue by an external auditor. This reactive stance is insufficient. Companies have a proactive responsibility to identify and manage risks, including those that could impact financial reporting, before they become audit findings. Relying solely on external audits shifts the burden of risk identification and mitigation away from the company's management, which is contrary to regulatory expectations. Professionals should adopt a proactive and comprehensive risk management framework. This involves establishing clear processes for identifying potential risks arising from any significant business change, assessing the likelihood and impact of these risks, and developing mitigation strategies. For financial reporting, this means actively considering how operational changes might affect accounting treatments, valuations, and disclosures, and ensuring that internal controls are updated accordingly. A structured approach, such as a formal risk assessment process, helps ensure that all relevant factors are considered, leading to more robust and compliant financial reporting. Question 17. Compliance review shows that Carlsberg's internal audit department is proposing a new approach to its annual compliance risk assessment. The proposed approach involves a detailed analysis of all potential compliance risks, categorizing them by likelihood and impact, and then developing specific mitigation strategies for each identified risk. This process will be documented and reviewed quarterly by the Compliance Committee. Which of the following best describes the most appropriate approach for Carlsberg to adopt, considering regulatory expectations for robust risk management? Option A. Implement the proposed systematic and documented risk assessment methodology, including regular reviews by the Compliance Committee. Option B. Rely primarily on historical compliance incident data from the past 5 years to identify and assess current risks. Option C. Focus the risk assessment exclusively on risks that have a high probability of occurring and are easily quantifiable. Option D. Outsource the entire compliance risk assessment process to an external risk management firm, with minimal internal oversight. The correct answer is A. Implement the proposed systematic and documented risk assessment methodology, including regular reviews by the Compliance Committee. Explanation. This scenario presents a professional challenge because it requires Carlsberg's compliance team to balance the need for efficient risk identification with the regulatory obligation to conduct thorough and documented assessments. The challenge lies in ensuring that the chosen risk assessment approach is not only practical, but also robust enough to satisfy regulatory scrutiny and effectively mitigate potential compliance breaches. The pressure to deliver timely results can sometimes lead to shortcuts, which can have significant legal and reputational consequences. The correct approach involves a proactive and systematic risk assessment methodology that integrates with Carlsberg's existing compliance framework. This method is right because it aligns with the principles of good corporate governance and regulatory expectations for robust risk management. Specifically, it ensures that potential compliance risks are identified, analyzed, and prioritized based on their likelihood and impact, allowing for the allocation of resources to the most critical areas. This systematic process provides a clear audit trail, demonstrating to regulators that Carlsberg is taking its compliance obligations seriously and has a structured approach to managing risks. It fosters a culture of compliance by making risk assessment an ongoing and integral part of business operations, rather than a reactive exercise. An approach that relies solely on historical incident data without forward-looking analysis is incorrect because it is inherently reactive. While historical data is valuable, it does not account for emerging risks or changes in the regulatory landscape that could expose Carlsberg to new compliance failures. This failure to anticipate future risks can lead to significant regulatory penalties and reputational damage. An approach that focuses only on high-profile or easily quantifiable risks is also incorrect. Selective focus ignores potentially significant, albeit less visible, compliance risks that could still result in substantial fines or operational disruptions. Regulatory frameworks typically require a comprehensive assessment of all material risks, not just those that are immediately apparent or easily measured. Finally, an approach that delegates the entire risk assessment process to external consultants without internal oversight or validation is professionally questionable. While external expertise can be beneficial, Ultimate responsibility for compliance risk management rests with Carlsberg's management. A lack of internal engagement can lead to a disconnect between the assessment and the company's operational realities, potentially resulting in an assessment that is not fully actionable or integrated into the business. This can also be viewed by regulators as an abdication of responsibility. The professional decision-making process for similar situations should involve 1. Understanding the specific regulatory requirements applicable to Carlsberg's operations. 2. Identifying the scope and objectives of the risk assessment. 3. Selecting a methodology that is comprehensive, systematic, and proportionate to the risks faced. 4. Ensuring adequate internal resources and expertise are available for the assessment. 5. Establishing clear roles and responsibilities for risk identification, assessment, and mitigation. 6. Implementing a process for regular review and updating of risk assessments. 7. Maintaining thorough documentation to demonstrate compliance and inform decision-making. Question 18. Compliance review shows that Carlsberg's internal audit team is proposing a new approach to assessing operational risks. The team suggests prioritizing risks based on the subjective judgment of senior management, focusing primarily on those risks that have generated the most discussion in recent board meetings, and using informal notes as the primary record of findings. Considering the regulatory framework and guidelines applicable to Carlsberg, which of the following approaches would be most professionally sound and compliant? Option A. Implement a structured risk assessment framework that involves systematic identification, analysis, and evaluation of risks, supported by comprehensive documentation and clear methodologies aligned with UK regulatory expectations and SISI guidelines. Option B. Prioritize the speed of assessment by conducting brief interviews and superficial reviews, aiming to produce a report quickly, even if it means sacrificing depth and detail in the analysis of potential risks. Option C. Focus solely on risks that have been frequently discussed in board meetings, assuming these are the most critical, and delegate the assessment of other risks to individual department heads without a centralized review process. Option D. Adopt the proposed approach of relying on senior management's subjective judgment and informal notes to identify and prioritize risks, as this ensures focus on what is perceived as most important by leadership. The correct answer is A. Implement a structured risk assessment framework that involves systematic identification, analysis, and evaluation of risks, supported by comprehensive documentation and clear methodologies aligned with UK regulatory expectations and SISI guidelines. Explanation. This scenario presents a professional challenge because it requires Carlsberg's compliance team to balance the need for efficient risk identification with the regulatory obligation to conduct thorough and documented assessments. The challenge lies in ensuring that the chosen risk assessment approach is not only practical but also demonstrably compliant with the relevant regulatory framework, which likely mandates a structured and evidence-based process. The pressure to deliver timely insights must not compromise the integrity or comprehensiveness of the risk assessment. The correct approach involves a systematic and documented risk assessment methodology that aligns with the principles of the UK regulatory framework and SISI guidelines. This approach is right because it ensures that potential risks are identified, analyzed, and evaluated in a structured manner, providing a clear audit trail. Specifically, it adheres to the likely requirement for a risk-based approach, where resources are allocated based on the likelihood and impact of identified risks. The documentation aspect is crucial for demonstrating compliance to regulators and for internal oversight, ensuring that decisions are informed and defensible. This aligns with the general principles of good governance and risk management expected under UK financial regulations and SISI professional standards, which emphasize due diligence and robust internal controls. An approach that relies solely on anecdotal evidence and informal discussions is incorrect because it lacks the rigor and objectivity required by regulatory bodies. This failure stems from the absence of a structured methodology, making it impossible to demonstrate a systematic identification and evaluation of risks. It also fails to provide the necessary documentation for audit purposes, potentially leading to regulatory sanction. An approach that focuses exclusively on high-profile risks without considering the cumulative impact of smaller, more frequent risks is also incorrect. While high-profile risks are important, regulatory frameworks often require a holistic view of risk exposure. Neglecting lower-tier risks can lead to a false sense of security and may result in significant unforeseen losses or compliance breaches when aggregated. This approach fails to meet the comprehensive risk assessment expectations. Finally, an approach that prioritizes speed over thoroughness, leading to superficial analysis and incomplete risk mitigation strategies, is professionally unacceptable. Regulatory expectations demand that risk assessments are sufficiently detailed to inform effective decision-making and control implementation. A rushed assessment risks overlooking critical vulnerabilities, thereby failing to meet the duty of care and potentially exposing Carlsberg to significant financial and reputational damage, which would be a clear breach of regulatory and ethical standards. The professional decision-making process for similar situations should involve 1. Understanding the specific regulatory requirements and professional standards applicable to Carlsberg's operations. 2. Defining a clear scope and objective for the risk assessment. 3. Selecting a documented methodology that is appropriate for the identified risks and regulatory expectations. 4. Ensuring that the assessment process involves relevant stakeholders and utilizes reliable data sources. 5. Documenting all stages of the assessment, including identified risks, analysis, evaluation, and proposed mitigation strategies. 6. Regularly reviewing and updating the risk assessment to reflect changes in the business environment and regulatory landscape. Question 19. Compliance review shows that Carlsberg's internal audit team has identified several potential operational risks related to a new market entry. Which of the following approaches to assessing and managing these risks would be most aligned with robust corporate governance and regulatory expectations? Option A. Conduct a thorough risk assessment that identifies potential threats, analyzes their likelihood and impact, and develops proactive mitigation strategies before significant investment is made in the new market. Option B. Allow each functional department involved in the market entry, e.g., sales, logistics, legal, to conduct its own independent risk assessment without a centralized review process. Option C. Prioritize immediate cost-saving measures for the market entry, deferring detailed risk assessment until after operations have commenced and initial revenue streams are established. Option D. Focus primarily on analyzing past market entry failures within Carlsberg and similar companies to identify lessons learned, assuming these will cover all foreseeable risks. The correct answer is A. Conduct a thorough risk assessment that identifies potential threats, analyzes their likelihood and impact, and develops proactive mitigation strategies before significant investment is made in the new market. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient business operations with the imperative to maintain robust risk management practices. Carlsberg, as a global entity, must navigate diverse regulatory landscapes and internal policies, making a standardized yet adaptable approach to risk assessment crucial. The challenge lies in identifying and mitigating potential risks proactively, rather than reactively, ensuring that the company's reputation, financial stability, and operational integrity are protected. Careful judgment is required to distinguish between acceptable business risks and those that pose a significant threat, necessitating a thorough and systematic evaluation. The correct approach involves a comprehensive and forward-looking risk assessment that integrates with strategic decision-making. This method is right because it aligns with the principles of good corporate governance and regulatory expectations for proactive risk management. By identifying potential risks early, assessing their likelihood and impact, and developing appropriate mitigation strategies, Carlsberg can make informed decisions that minimize potential harm. This proactive stance is often mandated by regulatory frameworks that emphasize a risk-based approach to compliance and operational oversight, ensuring that resources are allocated effectively to address the most significant threats. An approach that focuses solely on historical incidents is incorrect because it is inherently reactive. While past events can inform risk assessment, relying exclusively on them means that emerging or novel risks will likely be missed, leaving Carlsberg vulnerable. This failure to anticipate future threats is a significant regulatory and ethical lapse, as it demonstrates a lack of due diligence in protecting the company and its stakeholders. An approach that prioritizes immediate cost savings over thorough risk evaluation is also incorrect. This is a short-sighted strategy that can lead to greater financial and reputational damage in the long run. Regulatory bodies often scrutinize companies that appear to cut corners on risk management for the sake of expediency, viewing it as a failure to uphold their duty of care. Ethically, It prioritizes short-term financial gain over the long-term well-being and sustainability of the company and its stakeholders. Finally, an approach that delegates risk assessment entirely to individual departments without central oversight is incorrect. While departmental expertise is valuable, a fragmented approach can lead to inconsistencies, overlooked interdependencies between risks, and a lack of a unified understanding of the company's overall risk profile. This can result in regulatory noncompliance and a failure to implement consistent risk mitigation strategies across Carlsberg. The professional decision-making process for similar situations should involve a structured risk management framework. This framework should include clear procedures for risk identification, assessment, evaluation, treatment, monitoring, and review. It should also emphasize the importance of integrating risk management into all levels of decision-making, fostering a culture of risk awareness, and ensuring appropriate governance and oversight. Professionals should always consider the potential impact on the company's stakeholders, regulatory obligations, and ethical responsibilities when making risk-related decisions. Question 20. Stakeholder feedback indicates that several minor discrepancies have been identified in recent financial reporting data for Carlsberg's European operations. While the initial assessment suggests these are individually immaterial, there is a concern that collectively they could distort the overall financial picture. What is the most appropriate initial step for Carlsberg's finance team to take in assessing the risk associated with these findings? Option A. Inform the relevant department heads informally about the discrepancies and ask them to rectify them without formal documentation or escalation. Option B. Conduct a thorough investigation to understand the nature, cause, and potential aggregate impact of all identified discrepancies, regardless of individual perceived materiality, and assess the adequacy of internal controls. Option C. Prioritize addressing the discrepancies only if they are likely to cause significant negative market reaction or regulatory scrutiny. Option D. Immediately dismiss the findings as immaterial, given their individual insignificance, and focus on meeting the upcoming reporting deadlines. The correct answer is B. Conduct a thorough investigation to understand the nature, cause, and potential aggregate impact of all identified discrepancies, regardless of individual perceived materiality, and assess the adequacy of internal controls. Explanation. Scenario analysis. This scenario presents a professional challenge because Carlsberg, as a publicly listed company, has a responsibility to its shareholders and the market to accurately and transparently report its financial performance. The discovery of potential misstatements, even if seemingly minor in isolation, raises concerns about the integrity of financial reporting and the effectiveness of internal controls. The pressure to meet market expectations or avoid negative sentiment can create an environment where management might be tempted to downplay or conceal such issues. Therefore, a rigorous and objective approach to risk assessment is paramount to ensure compliance and maintain stakeholder trust. Correct approach analysis. The correct approach involves a comprehensive and objective assessment of the identified potential misstatements. This entails gathering all relevant information, understanding the nature and magnitude of the discrepancies, and evaluating their potential impact on the financial statements. Crucially, it requires engaging with internal audit and relevant management personnel to understand the root causes and assess the adequacy of existing controls. This systematic process ensures that any identified risks are properly quantified, understood, and addressed in accordance with accounting standards and regulatory requirements, such as those mandated by the Financial Reporting Council, FRC, in the UK. This aligns with the ethical duty of professional accountants to act with integrity and due care. Incorrect approaches analysis. Focusing solely on the perceived immateriality of the misstatements without a thorough investigation is an ethical and regulatory failure. While materiality is a key consideration, it should be determined after a complete understanding of the facts, not as a preemptive justification for inaction. This approach risks violating accounting standards that require all misstatements, regardless of initial perceived size, to be evaluated for their potential to influence user decisions. Ignoring the feedback due to time constraints or pressure to meet reporting deadlines is also a significant failure. Regulatory frameworks, such as the Companies Act 2006 in the UK, mandate that financial statements present a true and fair view. Ignoring potential issues that could compromise this view is a breach of this duty. It also demonstrates a lack of professional skepticism and a failure to uphold the integrity of the financial reporting process. Attempting to resolve the issue informally with the relevant department without proper documentation or escalation bypasses established internal control procedures and regulatory oversight. This can lead to a lack of accountability, inconsistent application of accounting policies, and a failure to identify systemic control weaknesses. It undermines the principles of transparency and robust governance expected of a company like Carlsberg. Professional reasoning. Professionals facing such a situation should adopt a structured risk assessment framework. This involves 1. Identification, clearly documenting the stakeholder feedback and the nature of the potential misstatements. 2. Assessment, objectively evaluating the potential impact, considering both quantitative and qualitative factors and understanding the underlying causes. This includes assessing the effectiveness of internal controls. 3. Response, developing and implementing appropriate actions to address the identified risks, which may include further investigation, adjustments to financial statements, or enhancements to internal controls. 4. Monitoring, continuously reviewing the effectiveness of implemented responses and the overall control environment. Throughout this process, maintaining professional skepticism, acting with integrity, and adhering to relevant accounting standards and regulations are paramount. Escalation to appropriate levels of management, and if necessary, the audit committee or external auditors, is crucial when significant issues are identified.